time has come for the Cobra to rise up and reveal himself.
Welcome back, my quiver of capitalists, to AP Economics, presented by Cobranomics, your all-American American history teacher, gold standard of economics, and sensei of supply side, Professor G here, and today we're going to take a look at our third economic indicator in Unit 3, Lesson number 3, the real gross domestic product growth rate. So first we're going to take a look at the definition of what it is. We're going to take a look at a couple of caveats about the word real versus nominal. So first, real gross domestic product is all goods and services produced and sold this year. So it has to be a good or service, it has to be produced this year, and sold this year. And it is all foreign or domestic entities within the nation's borders, and only within the nation's borders. So that's a person living in New York, it's a New York pizzeria, but it's also Nissan, a foreign company, in their plant in South Carolina. As opposed to, it is not, even though Apple is an American-based company, it would not be Apple's factory in China. It is only within our circular flow model. Gross domestic production, domestic referring to our nation's borders. And when we say all entities, we really do mean all entities that spend money on newly produced goods and services. Consumers, C plus I plus G plus NX. We're going to expand on this formula in our next slide. Consumers, investment spending, meaning business spending on capital products, government spending on newly produced goods and services, and net exports, meaning what we produce here and export overseas, subtracted from what we buy from overseas, what we import from overseas. So all entities within our circular flow model. Now, the word real is important as well, because as we saw in our last lesson with inflation, real means adjusted for inflation. So that means we have to calculate this year's production in last year's prices, because the nominal rate is not, the nominal GDP would not be helpful. Nominal, again, going back to inflation, meaning unadjusted for inflation. And we need to know, adjusted for inflation, we need to know this year's production in last year's prices, because what are we trying to do? We are trying to measure the health of the economy. So to accurately measure the health, we have to ask, are we spending? What does that big spending number mean? Are we spending more because we're producing more? Or that would be healthy, right? We're spending more because production has increased. Or is production stagnant? Is it not increasing and only the prices are increasing? That would give us an inflated number, and while the number might be nice, it means that the economy is not healthy. So you need the real gross domestic product to double check that all of the spending occurring within the nation's borders, within our circular flow model, using our resources to produce and to spend that money. Are we producing more? Are we spending more because we are producing more? So now let's take a look at how is this massive multi-trillion-dollar number, a number in the 20s of trillion dollars, depending on when you're going to be watching this video, is going to be how it is calculated. And really, right, we said it's all of the spending of the circular flow model. So we're just going to take a look at each aspect of the circular flow model. The most common aspect is what is called our expenditures approach. That formula we saw on the previous slide, because it's very simple, that easy to remember, the C plus I plus G plus NX. So, and remember too, it has to be made this year, it has to be a good or a service, and it has to be sold this year. So made and sold this year, made and sold, and a good or service. It must fit those 4 criteria. Otherwise it is not counted, and we will go into what is not counted in our next slide. So consumer spending, that is what households spend in the product market. Investment spending, be careful of this. This is a trick vocabulary word. Investment spending does not mean us buying stocks and bonds. Investment means in the sense of capital investment. So this is businesses spending money on capital resources, on factories, on equipment. Government spending, this is the government acting like a consumer and buying goods and services. And net exports. This is if America produces something, we produce products, and people from overseas buy it, so we are exporting the products. Minus imports, so minus the flow of our dollars going overseas. Unfortunately, for the past several decades, net exports has been a negative number because those imports are subtracted from the total number. So exports are added, imports are subtracted, and unfortunately currently this is a negative number. There's a big trick question within a couple of big trick questions with investment spending. So first big trick question, it's talking about businesses spending on capital resources, factories, trucks, computers, right? Anything that is a capital resource. It is not stocks and bonds. Those are not goods or services. We're going to talk about that in the next slide. However, if for a stock or a bond, if you pay a service to a financial investor to buy a stock or a bond for you, that would be consumer spending, that the service fee, because that is a productive service. So the profit from the stock or bond not counted, the service fee for a financial advisor purchasing for you, or a stockbroker purchasing for you, would be counted in consumer spending. And as we see here, this is really like adding up almost all of the product market. The national income approach is adding up the factor market. These are because what happens in the circular flow diagram, everything in the factor market, the income created in the factor market, becomes the money spent in the product market. And the money spent in the product market becomes the income to pay for the resources in the factor market. So because the circular flow model is circular, both approaches will get you the same number. So wages, profit, rent, and interest when businesses pay for resources. And in addition, that would be the national income approach. And in addition, when businesses do depreciation spending, this is where capital goods, those capital goods get wear and tear. We assume that those capital goods have to be replaced, and that's how you have the investment spending. So as the capital goods get wear and tear, they must be replaced and spent money on. And indirect taxes with subsidies, because those indirect taxes will then become government spending, not including subsidies. That's money given to businesses to produce, because that would be counted in that business production. So these are the two approaches. This is the most common approach, and on the AP test, the national income approach, if it makes an appearance, just think of it as adding up the factor market of the circular flow model. We're going to take a look at what is now counted, but first I want to go back a little to investment spending. Investment spending is the most complex of the three. One, it's kind of that trick misdirection. When we think of investment, we think of stocks and bonds. No. One, it is capital goods. That's always the dead giveaway for it. Two, it is real estate, because where do you put a new home? In what category? So technically, we put, and for real estate too, that's a big category. So if it is newly built, it goes into investment spending. And like newly built, newly purchased, it goes into investment spending, because just to put it into a category. And then three is, of the two categories, consumer spending or investment spending, it makes more sense to put it in investment spending. That's one of the more fluid ones. But so real estate, if it's ever asked, is always investment spending. And because it fits more neatly into the idea of capital, of land, of using land to create something. And three, inventory spending. This is when businesses spend money to put items onto their shelves to then be sold. And inventory spending is the main reason why GDP is always revised. If that item sells or not, that GDP being revised up or GDP being revised down, which we're going to see when we get to number 7 on not counted. So then another important point is that GDP is a number that's constantly being revised to account for if it's produced and sold this year. So let's go to not counted. One, like we said several times, financial instruments, stocks and bonds are not financial instruments. Stocks and bonds are financial instruments. They are not a good or a service. A stock represents a share of ownership in a company, and a bond represents a loan to a financial institution or a municipality or a corporation. So it's a loan from a person to a corporation, and then that person gets back their loan plus interest or an income. So they're important, stocks and bonds, but they're not goods or services. They're not actually produced. They're just financial instruments. So they're not counted. However, if you have a stockbroker or a financial advisor and they buy stocks and bonds for you, that service fee would be counted under consumer spending because the stockbroker is providing a good or service. Always a trick question. The purchase of the stock, like the dollar value purchase of the stock, so if you buy $1,000 of Apple stock, that $1,000 is not counted. If you buy, however, if your broker charges you $50 to buy that stock, it is counted. So the dollar value of the stock or the profit from the stock, not counted. The productive service for buying the stock or bond of the financial advisor or stockbroker is counted. Always a trick question. Definitely taking notes on that. 2, secondhand sales like eBay and Amazon and yard sales. Only the initial, one of the things with measuring the health of the economy is you don't want, let alone an actually inflated number, and this will lead to a double counted number. So like a technically inflated in the metaphorical sense that not there's a change in prices, but that we're counting stuff more than once, even though it was only produced that one time. So we only account for the initial purchase of the newly produced item. If you sell that item, even if it's the same year, even if that item gets sold and resold and sold again 3 different times on eBay the same year, it's only that initial purchase that is counted because we want to avoid double counting. We want to reflect a healthy economy that are we buying newly produced goods and services. So it is consumer spending that is occurring, but it does not count as consumer spending in GDP because then it would be double counting. 3, intermediary sales. This is like when Heinz buys the tomatoes to make the ketchup. The tomatoes are not counted in GDP and inventory spending for GDP. The final sale would be when the Stop and Shop adds the Heinz ketchup to inventory, and then that number is revised to consumer spending when a person buys the Heinz ketchup. Because where are those tomatoes counted? Those tomatoes are counted in the final sale of the product. Those tomatoes go towards the final price of the product. So Heinz purchasing the tomatoes, even though they are purchasing them from a tomato farm, that purchase of the tomatoes is not counted because they are an intermediary item. They are a middle item for the final product of the ketchup. Illegal sales, right? Obviously these are, the government does not keep track of them. These are totally off the grid, although we see in many different states that things like marijuana are being moved, would be counted in GDP as things that are previously illegal now become legal. That would now be counted towards GDP. Number 5, transfer payments. This is if you get a birthday check, or the government gives you Social Security, or you get a retirement check, It is just a regular transfer of money, and it is not a good or service. And the big trick question here is, oh, the government gives you a Social Security check. That's not government spending. Government spending is when the government acts as a consumer to buy newly produced goods or services. This is just the government giving you a check, so that's a transfer payment because it is not a good or a service. 6. Outside the border could be broken into two categories. One, if it's a U.S. company, so let's say that Apple in making products in China, and that would be counted towards GNP, gross national product. An interesting number, this means all of the national companies, no matter where they are in the world. However, interesting number, important number, not one of the top 3 indicators for the health of the economy, because that Apple factory in China is not using American resources or paying American workers. So it is not counted in, so the products made there are not counted. As we said before, imports, not only are they not counted, but imports are subtracted because that is American money leaving our circular flow model. And the trickiest, and this is where the AP test will kind of give you like the life story of a product, and one of the trickiest ones is, let's say it's made in 2019, sold in 2020. What do we do with this product? And this is why revision is so important. So, it would count as inventory spending in 2019 because a company paid money to put this item on their shelf. And if it's sold in 2020, it would not be counted because that item would have already been counted in 2019, and if we counted again in 2020, then it would be double counting. We are only counting newly produced goods and services. So it's great that item sold, however, it's not counted in 2020 because we would technically be counting that item twice. So it would only be counted as inventory spending in 2019.